Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased to welcome back Paul Wong, Sprott's Market Strategist. Paul, thank you for joining Sprott Radio.
Thanks, Ed.
For our newer listeners that are joining for the first time, could you just tell us a bit about yourself and some of the work you do at Sprott?
Sure. Been in the business, I think, more than 35 years. Been involved with hedge funds, been a prop trader. I've run resource funds. I've been on asset mix committees. And before all that, I used to be a geologist my first career. At Sprott, I am a market strategist. I provide market commentaries and internal research for the Sprott people.
Well, Paul, we got a lot to talk about today. um,
There's a lot going on.
I was looking at the numbers year to date, and we're at the mid level of this year, which is kind of hard to believe in itself. It seems like it's gone really fast, but I thought it'd be interesting to review really what's happened in the last 6 months and maybe give a glimpse of what might be happening going forward. Let's just start with the last 6 months. Maybe give us a couple of highlights of the last 6 months. What's happened, what you've observed, and what might be different.
Year to date 25 has been pretty dramatic. I guess the big thing really is the return of Trump 2.0. I guess that a lot of these items I'm going to talk about, they were sort of in the process of occurring, starting even before, Trump 1.0. But since the return of Donald Trump in January this year, it's really accelerated. What he has proposed or proposing doing is essentially reordering the global trade system, leading towards trend towards further de-dollarization. He's trying to influence monetary policy. He is expanding U.S. deficits to extraordinary levels, and he is changing the entire architecture of the U.S. institutions. Any one of these items would be, pretty dramatic, but the fact that all of them are occurring simultaneously is it's leading to a lot of confusion, uncertainty in the marketplace, and probably what we've been seeing for a while now, and then likely will continue this year and probably next year as well.
One of the things I wanted to do today was really unpack something you've been talking about a fair amount, and I think it's an interesting topic, which is we're seeing a lot of similarities to the 70s, 1970s, to today. So I thought it'd be fun, really, for our listeners to kind of go through that. What does that mean? What does it look like when you think about things like oil, gold, the economy, inflation, all these things? If we could just go through that and talk about kind of what you really mean when you see these parallels between the 70s and today. Let's start with that, and something maybe that everyone follows, probably maybe even more closely than gold, would be oil. What's going on in the world today, and why are there so many similarities to what we saw in the 70s?
Well, with oil, actually, it's very different today versus the 70s. In the 1970s, we had geopolitics really influence oil. We had the OPEC oil embargoes. We had the Iranian Revolution cutting off supply, so we had massive oil spikes. Today, we don't really actually see that. Today's oil market is actually relatively well supplied, and today oil is different. U.S. shale didn't exist back in the 70s. Today, it's the primary driver of oil growth. In the 70s, the U.S. needed to import about roughly 70% of its oil needs. Today, it's completely oil independent. So, in terms of oil, there's not a lot of similarities. Where the similarities lie, though, is that there is an stagflationary impact that's being felt in today's world, much like the 70s. There's a lot of geopolitical instability that's occurring today. Part of that is the process of we left the prior 30 years of globalization. We are now deglobalizing into a multipolar world where we're seeing the return of superpower competitions, economic competitions amongst different countries. We're seeing excessive monetary policy, changes in the currency reserve systems. 1970s we had the end of the Bretton Woods system that echoed through for almost a decade into the 70s. Today we are in the process of going through a de-dollarization process. Some of it driven by the administration, some other countries wanting or needing to de-dollarize. But the process is there. It'll be, again, probably a long, gradual process like the 70s, and that will have its own implications. It's the uncertainty, the dramatic changes in geopolitics, it's the changes in economic outlook. There's a lot of uncertainty going on today, much like the 70s.
You mentioned Bretton Woods. In corners of the room, for sure, people talk about a resurgence of a Bretton Woods kind of policy. Is that a gold bug mentality, or do you see with central bank buying that to be some sort of way, shape, or form reality where we start pegging things back to gold?
Right. I guess it'd be an echo of the Bretton Woods system. So Bretton Woods
Mhm.
was really was a it's a gold reserve system, meaning at the time the U.S. dollar was convertible directly into gold. And Nixon broke the gold convertibility in 1971. Essentially, the U.S. was running massive deficits with the Great Society programs and the Vietnam War. And at the time, I think everyone realized that was the gold system was no longer sustainable. Many countries were starting to force conversion of US dollars into gold. And if that kept occurring, then the US would start to lose its gold reserves. So that's why the system was ended. Today, what we're seeing more likely is a movement towards I guess, a multi reserve system, multi asset reserve system, with gold a key component of that. Depending on who's calculating the numbers and how they're calculating. Right now, gold is about it's moved up to about 25% of central bank reserves now, up from about, say, something in the call it the 10 to 12% range near the lows. And again, the numbers vary depending on who does the calculation, but that's roughly about the same number. And today, right now, we're seeing that number increasing either through gold price appreciation versus fall in the U.S. dollar, fall in U.S. bonds, but also continuing purchases from central banks, predominantly the developing economies and the emerging economies.
And if I saw this correctly, there's a couple different research pieces out there saying that surveys with central banks and so forth see that continuing at least for the next 12 to 24 months based off the kind of the hand they're showing. Do you buy into that? Do you think the central banks are going to continue to be buying? Do you think, and is that the primary reason why gold continues to move is because the central banks are propping it up? Or is there more going on than that?
Central banks and sovereigns have been the predominant buyers of gold. Basically, there's a sort of a stacking effect. The
Mm-hmm.
first stack layer we saw was in the Q3 of 2022 when central banks started, purchasing enormous amounts of gold, 2.5 times on average what it used to purchase a decade prior. And that was really driven by, the seizure of Russian reserve assets. So the whole notion of U.S. Treasury as sacrosanct was basically removed at that point in time. So any central bank that had an adversarial or semi-adversarial relationship with the U.S. or the West thought long and hard and probably started buying gold and start repatriating their gold out of the Western bank vault, London vaults, and we've seen that process occurring. And then with inflation as a store of value, as a hedge, we started seeing more central banks buying gold because obviously bonds you know would be damaged, currencies would be damaged in the face of inflation. And then we started seeing the trend towards de-dollarization. So again, ties hand in hand. And now with the second Trump administration is openly questioning benefits of a high U.S. dollar. They openly want to bring down the U.S. dollar, and that in itself will increase the value of gold and pretty much any other hard asset that's measured against the U.S. dollar.
Well, and if we de-dollar and if Trump becomes the head of the Fed, I don't know if you saw that comment
Oh yeah, I
recently,
saw that.
and he drops rates by 250 basis points in one day. I mean, I got to believe that helps gold as well. If you get rates aggressively dropping yet again, bonds struggle, dollar weakens, gold goes higher. I mean, it seems like right now all the black swans are sort of jumping in the pond together at the same time. I had a question last week actually about what white swan could come in and actually change the direction of this, and it doesn't seem like there's one out there right now. What's your thought on that? I mean, is this kind of the new normal for the foreseeable future?
right? It's hard to see a white swan. I mean, what would drive a white swan? Basically, it's a return to globalization. It'd be a return to free trading systems,
Hmm.
multilateralism. It's basically the reverse of what we've seen, especially this year and the last few years. It doesn't seem like we're heading towards that direction. This is probably a multi-year process, which we've only started, and we'll probably continue along this path. The fact that the next Fed chair will likely be hyper dovish. It's pretty obvious President Trump wants lower rates. I think his tweets are considered official. His last tweet said he wanted 250 basis point
Right.
rate cuts, which should be that's a pretty big rate cut.
Yeah.
That would obviously that would drive yields down in the short end and probably push up yields in the long end considerably. You get an absolutely wicked bear steepener on the curve, and that would literally push down the US dollar and drive gold up higher. The whole idea of an independent Fed would go out the window. Again, parallels the 70s, Arthur Burns, that he was Nixon's Fed chair at the time, and he kept a very, very easy monetary policy. And that was one of the key drivers leading towards inflation and stagflation.
Well, speaking of the 70s, between 1970 and 79, and where do you think we kind of are in that cycle? Because if you look at gold's returns in the 70s and silver's returns relative to the S&P, they did quite well. They were up over 30% on average per year, and they sort of peaked in 79. So if you're an investor thinking about this, hey, I missed this move, maybe I did, maybe I didn't. Where do you think we are right now in that 10-year span from a market cycle standpoint?
Again, it's not perfect, but I would guess we're somewhere around 1976, 77.
Okay.
I'm just using the inflation plot. So if you plot U.S. year over change CPI, what you saw was a large peak. It was 74 roughly, and it started to trend lower. And then it made its lows in 76, 77, and it started turning back up. 77, 78, 79, we started seeing the first signs of yields higher, dollar lower, gold higher, equities lower, much like we saw when Trump announced the tariffs in early April, Liberation Day tariffs. That really cracked the market. And for the first time since the late 70s, you saw that effect where yields were higher, dollar lower. Typically, you see that in emerging markets. Typically, that is a sign of asset capital flight away from U.S. assets. Something you had not seen since in the late 70s.
So what you said earlier, I think kind of tracks then that this is a multi-year potential opportunity cycle as people look to allocate capital, whether you're an existing investor and how to rebalance or a new investor coming in. This is an area I think that certainly deserves some additional attention. One of the comments that was made recently when we talked about central bank buying is that silver is doing pretty well also, and central banks aren't buying silver at all. So I guess the question is silver stepping out of gold's shadow, finally becoming its own metal? What's happening in the silver market right now?
I still see silver as it still has a monetary value. So if you run correlations on silver versus gold, it still has a very high correlation. Long term, that correlation is stable. Short term, you will get some variation, but typically the long term correlation is still pretty robust. So it's still maintaining a store of monetary value. Silver has always had an industrial component as well. So it too runs a very high correlation with copper being the ideal metal for tracking economic cycles. So we have that going on. In the reports that I've written in the last few months, what's become apparent is that the amount of free trading silver in inventory has been depleted. You can see it in the Silver Institute data. If you look at the supply demand picture, the amount of silver drawn out of inventory is roughly about 100 million ounces. You can see that it takes very little buying now in silver if you use silver held in ETFs and CFTC positioning. So that is a proxy for investment demand for silver. It takes very little buying now to push the silver price higher.
Mm-hmm.
And that's a sign that you're probably depleting that free trading inventory of silver, meaning that the demand for silver, especially through retail investor investment funds, you're getting closer and closer to a price squeeze in silver. Again, Don't know when, don't know what level, but you can kind of see the progress in that direction. So while silver may not have central bank buying, it has investment flow buying. And
Hmm.
again, if you look at the Silver Institute data, go down the line where it reads, investment demand from ETPs or ETFs, they are the swing driver of silver. Once they realize that, the amount of silver inventory, again, you can look at the LBMA data, there's been a massive drawdown in silver, and you're getting closer and closer and closer to an eventual silver squeeze. It can happen. Best way to put it, when you buy a lot in a very short period of time, that's how you initiate a squeeze. If you buy a
Hmm.
lot over a long, protracted period, you may not get a squeeze. But if you look at the buying history of retail investors, they tend to come in swarms, and they can literally initiate a silver squeeze out of the vaulting system.
And what do you make about silver then also kind of becoming more of a true consumer metal in that, it gets talked about more and more in the critical material side, whether you're talking about solar panels, you're talking about reflective technology and cameras and so forth. Unlike gold, which is really, maybe there are some uses, but really it's a monetary metal, where silver is really that bridge metal, as I like to call it. You think that's adding fuel to the fire as well, or do you think it's still predominantly being driven by the investor side of it and the aggressive buying side of it?
Oh, in the long term, it's driven by, I guess, the use of silver in more electronics, more
Hmm.
advanced technologies. As a conductor, there's nothing better than silver. So if you want to increase the efficiency of any electrical system, solar panels was a good example. You need more silver. Recently, there's been some thrifting in the newer silver technologies. So we're seeing, the Silver Institute has a relatively, flat demand profile for this year, next year. But as more applications develop in the future, more panels get rolled out, you will probably see an increase in again in silver loadings for the solar panels. I think in the U.S., because of the rollback and the energy transition,
Hmm.
I think there's a lot of negativity towards the whole energy transition theme. But if you look globally, the pace has not changed. It's accelerating in some areas, especially China.
Yeah, it's amazing sometimes how we get it as an investor. We're going day to day, but the reality is we need this. We need so much more of this stuff long term. But the market sort of gets it wrong in the short term, and then they kind of wake up to, oh wait, hang on, we actually do need this longer term. We need to keep investing in it, and I think that's kind of fascinating that happens. I mean, let's shift to another gear now. So we've talked about gold a little bit. We've talked about silver. I mentioned I wanted to talk a little about uranium and copper because I think that falls under the line of just general commodities or hard assets in general. Can you spend a few minutes talking about them? Because here at Sprott, that's a big theme for us. Can you give a few comments on both those? How people should be thinking about those two metals today?
I guess it comes down to security, energy security, especially for uranium. In terms of a green energy, base load power, in terms of size, scale, there really isn't anything that can match with nuclear power. As we deepen into deglobalization, we will likely see more and more geopolitical conflicts, more and more geopolitical stress. And usually, typically, what it does, it plays out in terms of energy security. Energy security becomes the overriding concern. We actually haven't had that for almost 3 decades, since the 90s. I'm old enough to remember, energy security from the 70s and the 80s.
Yeah.
And that was a real important stress point for, advanced economies. So we were heading back towards that as well. Again, you think about uranium in terms of energy security. It's impervious to any embargoes, any disruptions, and it's clean, it's scalable. Newer technologies are emerging right now that'll broaden the reach and scale of it. We are also heading towards the fourth industrial revolution. Power demand is rising. It's rising faster, and it's had probably since the 60s. AI is the most. I guess it's the most topical. Energy demand right now, but it needs power. It needs clean, reliable power. And nuclear power is the best fit for that growth in AI. It is the future of the economic growth in the U.S. And the U.S. will need ever more large, secure electricity sources. And nuclear power it's the best of that world. Solar and wind is great as long as you have batteries attached to it.
Right.
That works well. But in terms of scalability, nuclear is what you need. In terms of the absolute sheer amount of power the AI data centers will demand. Again, part of that feeds into copper. I did a note a while ago on copper demand related to AI. Again, it's think about it. So AI, you're going to need to expand the grid in the U.S. The grid is parts of the grid are over 100 years old in the states. Bulk of it was built in the 60s and 70s. So that and a lot of that needs to be rebuilt. Again, electrification, the whole theme of digital economy, growing electrification of the economy. You're going to need copper. Copper is by far next to silver. It's the second best conductor
Mm-hmm.
around. Unlike silver, it's a fraction of the cost of silver. So
Right.
it's actually
For now.
for now. We can see the future of manufacturing is robotics. It's automation, robotics. Again, the fourth industrial revolution.
Right.
It's the age. It's the age of electrification. That means electricity demand, nuclear, and that means copper.
Well, Paul, it's always great to talk to you. I start every week talking to you. And I look forward personally to your reports, and anyone out there that's following us. We do publish Paul's piece once a month, just really more of a weather report of what's going on in the market, but I think you'll find it insightful. So if you want to follow us, I encourage you to do that. Paul, again, thank you for joining us on Sprott Radio.
Great. Thank you, Ed.
And once again, my name's Ed Coyne, and thank you for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.